Hello and welcome in this channel. In this video, we are going to cover about liquidity and inducement. What is liquidity? Liquidity basically means money. So for the market to move, investors have to put in money. And when we talk of inducement, we mean a trap. This is where the smart money usually manipulate the retail traders to put in their money at a zone where they should not have entered the market. Then afterwards, they get to liquidate them and take their money. Then we have different types of liquidity. And the first type of liquidity that you are going to cover is external and internal liquidity. Then we have trendline liquidity. We have equal highs, equal lows, and we have buy side liquidity and sell side liquidity. Let me use a skeleton to explain each before we continue with the video to the charts. So when you have external and internal liquidity, for example, on an uptrend, you find that the market usually moves from higher highs, higher lows, higher highs, higher lows. So the type of liquidity that we have here, we have the external type of liquidity, whereby at these points, at the swing highs and at the swing lows, you have external type of liquidity. It basically means that sellers put their money at this point for this short, while buyers put their money at this point for them to go long at that position. So the same thing happens. So we have money at this point, money at this point. So these are external type of liquidity. So that is external liquidity. The same thing when you have the market moving on a downtrend. So if the market moves on a downtrend, it means that as the market moves from higher lows, lower highs to lower lows, it means that money is at these points here. So we have liquidity above these zones. And on external liquidity, you must follow the market direction for you not to get liquidated. Okay, this is what I mean. If you are trading based on the market structure, that is break of structures, change of characters, when the market breaks structure at this point, it means that it takes out the higher highs at this point. So we have the liquidity being taken above these points here, while the market will maintain the higher lows at this point. The same thing, as the market continues to give us the break of structures at this point, so we have the liquidity being taken out on the lower lows at this point here. So the market is breaking structure to the downside, taking liquidity out at this point. So if you are a buyer who was trading against the trend and you had your buy positions at this point, it means that you have your money in place at that point. So eventually, the market will come and take you out. So that is how the external liquidity works. Then we have the internal liquidity. Okay, when it comes to internal liquidity, this is whereby you find that the market will manipulate traders, then get to a zone on a point of interest. For example, let's say we have a demand at this point. This is how internal liquidity works. You have internal liquidity at these points here. So we have early buyers tricked by the market that we are going for longs at this point and short positions at this point. So this is this is internal type of liquidity, whereby you see that you have a point of interest, so you get early in the market, then the market comes and liquidates you. So you have your orders at this point, and you find that the market will come, take you out, then continue with the same direction in which you are intending to go. So that is how the internal type of liquidity works. So the same way, if I may use the break of structures, you find that as the market moves from higher highs, higher lows, so you find that in most cases, you have a break of structure at this point, and you had a break of structure at this point here before this move happened. So before this move happened here, this was a clear break of structure. But the moment this low is taken out, remember one of the rules when it comes to the break of structure, it states that the previous low on an uptrend should not be taken out, while the previous high on a downtrend should not be taken out. But this low has been taken out. So it means that the market has taken out liquidity below this level here. And by doing that, this one invalidates this break of structure here. So we do not have a valid break of structure at that point. So the valid break of structure that you're going to be looking at is at this point here, because we usually look at the highest point and at the lowest point in the market. So that is why we are going to have a break of structure, because we have taken out this low here. So this is internal liquidity being taken out. Yeah. So let's go to trendline liquidity. When you are talking of trendline liquidity, for me, I would say that the reason why we have smart money having an upper hand is because of liquidity. So when you have trendline liquidity, it means that the market, anytime the market comes to this zone, sellers enter the market at this point. So this is what you find. And you have the trend line as a strategy whereby we have people use the trend lines as their entry points, which I will not say that it is a bad strategy. Every strategy works, but you must know when to take the profits and not when to be in the market. So you have sellers enter the market at these points here. So it creates a pattern, a repetitive pattern. And at the end, you find that you are in the market, the market will trigger you to get into the market, come and take out the orders above this point. Again, sometimes it tricks even the buyers to think that we are retesting this level here, then the market continues with the normal downtrend direction, taking out the liquidity of these people, of the sellers who are going to enter the market once it taps on this trend line, and again take out the liquidity of the buyers who are going to get into the market when the market retests this trend line after a breakout. So that usually happens in the market, and the opposite is also true when you have the market moving on an uptrend. So it's just the same thing. So you have buyers entering the market at these points here when the market taps on the trend line. Then eventually the market will come back to the trend line, retest it, trigger the buyers to get into the market at this point. Then you're going to see the market take out the orders, retest the trend line, then perhaps either move in the opposite direction or continue moving in the same direction. So that is how we have these types of liquidity work out. Then we have the equal highs and equal lows. When it comes to equal highs and equal lows, when the market is consolidating, in most cases, you find that the market is forming equal highs and equal lows. So you usually find that the market we have the equal highs at this point and the equal lows below here. In most cases when the market is consolidating. But you're also going to find some of the scenarios whereby the market will form equal highs. And in most cases, you're going to find that if you're trading the chart patterns, you're going to get liquidated because for you, you're going to see that this is a double top, sometimes the double bottom. That is what you're going to see. But eventually the market will come and take out liquidity above this level. So we have this as equal highs at this point. So the market has its own way in which it will come and take out liquidity above these points here, where we have the equal highs and equal lows. So you find that the market will actually take out the orders at this point, take out the orders, then perhaps continue moving upwards or even downwards. While we have the equal highs or even the equal lows, so the same thing will happen. You see that the market will eventually come, take out the orders be above that point, and continue moving, perhaps downwards, after taking the orders above these points here. So that is how equal highs and equal lows works. Then we have the buy side and the sell side liquidity. When it comes to the buy side liquidity and the sell side, so we have our point of interest at this point. So this is our point of interest. So you see that the market usually retest, and when the market comes here, it creates something that we call the sell side liquidity. So what is sell side liquidity? Sell side liquidity refers to orders where the stop loss have been placed by traders who are holding long positions. So you find that buyers are entering the market and they have their stop loss orders below this point here. So you find that the stop loss of early buyers are at this point. Then the market comes, takes out the sell side liquidity and continues moving upwards. So we usually have sell side liquidity below a point of interest. May it be a demand zone, a fair value gap, an order block, and all that. So you have your orders at this point, and this becomes our sell side liquidity at that point. Then we have the buy side liquidity. For the buy side, you find that Okay, let me put it like that. So this is where we have our point of interest at that point. So this is the risk zone where we should be waiting for the market to come at that point. Then we have our sellers setting their stop losses above this point. So you have your buy side liquidity at this point. So the stop losses of the early sellers are above here. And you find in most cases, when you have sell side liquidity being created, it is because that we have a inducement zone at this point. And in most cases for me, I find out to be the fair value gaps. So you have an inducement zone. So this is a trap to get you into the market. Then finally, the market comes and takes out, swipes your orders below this point, then continues with the same direction in which you are expecting the market to go. So you're going to see so many scenarios in this market whereby we have this type of liquidity. So let's go to the chart and start looking at the different types of liquidity that we have in the market. Okay, looking at this, first of all, you can see that we have this downtrend here. So at this point, you have a point of interest, which is this supply zone at this point. Though the market does not come all the way to this supply zone, which we have at that point. But let's fix our eyes at this point here. So you have the market start to retrace up to this point, and you can see that we have the sell positions entering the market at that point. Then above here, you can see that market comes and takes out liquidity above this point. So liquidity has been taken out at that point. Then the market continues moving downwards. Again, from here, you have this fair value gap, and you can see that sellers entered the market from that fair value gap from this point. So if you're trading a fair value gap, for me, I advise traders that enter the market and aim for a risk to reward ratio of 1:2. By doing that, you have high chances that you're going to survive. But aiming higher, then you are getting yourself into trouble. Then we have this above it, above the supply zone, we have this supply. So you can see the market comes and takes out liquidity above this fair value gap. So we have this. So the fair value gaps at this point serves as an inducement zone. So this is an inducement zone triggering sellers to enter the market. Then eventually the market takes out their orders above here, gets into the supply zone. Then you can see the market continues moving downwards. So what type of liquidity do we have at this point? So this is a buy side liquidity at this point. So you can see the market comes, takes out the buy side liquidity, gets into the zone, then continues moving downwards. Let's look at other examples. So other examples that we have this zone here at this point. So have a look at this. So at this point here, you can see that you have this demand. At that point, then the first time the market mitigates this zone, then continues to push upwards. So you find that people are going to place their orders some few pips below here. Then the market continues with the same direction, and they are happy that the market is going on their side. Then eventually the market comes, takes out the liquidity, then continues moving upwards after it has taken out liquidity below here. And one thing, when it comes to trading, you must be aware of the liquid hours in the market. Then from there, we have this area of demand. So this is our demand zone at that point. Have a look at this. We have the early buyers enter the market from this demand. So this demand zone, when you have 2 points of interest, look at the extreme point of interest, which is this demand that we have at this point. So this demand zone here serves as an inducement zone, because early buyers are going to be triggered to get into the market at this point with their stop loss orders just some few pips below here, and perhaps their aim going upwards, perhaps up to that point or even higher. Then the market starts to reverse and come to the point of interest, which is at the extreme edge. Then gives you that entry in the market. So you can see those that kind of scenario whereby the market will do that. Okay. Then let's look at a different type of liquidity. That is, we say that we have external liquidity. So this is also internal. This is a type of internal liquidity, whereby you find that you have this zone here. Then the market will take out the orders below this point, get to the true zone, then continue moving upwards from that point. So let's have a look at the market. Let's go to the 1 hour time frame. And on the 1 hour time frame, you can see that we have this market. You can see the market direction is a downtrend. So if you start marking the break of structures at this point, this is where you have that break of structure at that point. Another break of structure at this point. So where do you have the external liquidity? You have people place their money at that point, at this point, for sell positions, while this point for buy positions, this point buy positions. So the market, on a downtrend, the market usually takes out the lows, that is the lower lows in the market. So you have these as your lower lows. So the market takes out these lows when breaking structure to the downside. So that is what you see. The market usually takes out the lows at this point. Okay. Then from here you have the next break of structure below here. So that is where you have an area of break of structure. Like that. So these are external type of liquidity. You have people placing their money at these points. Then we have the trend line. The trend line liquidity. So have a look at this. The market taps into this point, gives us that sell position. From this point, gives the sell position. That point, sell position. The next time the market comes to tap onto this trend line, what does the market do? Sellers take that bait. So you start entering the market from this point. The markets get to liquidate you. Then comes and you can see at this point it retested this fair value gap or came to fill orders at this fair value gap which we have. If I may expand, you're going to see that you have this fair value gap above this point. And actually, this is the candlestick that gives you the buying pressure. So it's your area of demand. So this is your area of demand. So this is how the trend line liquidity works. It's either you find that the market will retest, give you that sell position, then takes you out, then continues with the same downward direction after it has taken the orders. Or else in such a scenario whereby you can see that the market comes, taps into this trend line, and sellers get triggered because you can see these bearish candlesticks start to form here. It means that sellers were ready to enter the market at this point, but buyers take over the market and continue to push the market higher from that point. The other type of liquidity that I have not touched on, okay, when you come to the market, you need to analyze the market using the top-down analysis model. Do not be stuck on a single time frame, because if you're stuck on a single time frame, you may miss on very good, like you may miss on important information, whereby you enter the market at a point where you should not have entered the market. Okay, let me show you. Let's go to the 4-hour time frame. So this is what we have on the 4-hour time frame. We have this area of supply here. We have that area of supply. So this area acts as an inducement level because early sellers will enter the market at this point. Whereas we have this area which has not yet been mitigated. We have this inefficiency in the market. Hope you can see that we have fair value gaps at this point. So that is imbalance in the market. So the market must come and give us that balance in the market. So if you're stuck just on a single time frame, you might not see that in the market. So for you on the 1 hour, you might be seeing that the market is very efficient. So the market comes all the way to fill that fair value gap partially. So we have the market fill the fair value gap partially and takes out the orders above that above this supply which we have on the at this point here, then gives you now that sell position. You can see that after it gets the supply zone, you have that sells continue all the way downwards. So you need to have a different view of the market on multiple time frames. Do not be stuck just in a single time frame. Yeah, and with that,